Right, in this video we're going to have a quick look over at the financials of Adyen, payment processor located on the Euronext of Amsterdam. It's a relatively young company. They were IPO'd in 2018 and therefore they do not necessarily have a lot of history for us to look at, but we can look over their past few years of financial results and see exactly what's been going on with this company. Adyen quite recently saw a massive drop in their share price. So let's see exactly where this drop is coming from and let's see what we can expect here from Adyen into the future. Simply looking over at their revenue and EBITDA numbers, we can see a massive growth story here for Adyen. 1 billion in 2017, 9 billion euros in 2022. An annual increase of about 44% in revenue and 52% in EBITDA. This is nothing to sneeze at. These numbers are absolutely terrific. And these numbers are the exact reason why Adyen has seen such a massive share appreciation for the past few years. But then again, it also shows us exactly what's been going on with them recently. But we'll get to that in a little bit. They have basically no debt on their balance sheet, but they do definitely have some excess cash remaining in their checking account. There is no risk of bankruptcy for this company whatsoever. They do not really buy back shares, they don't pay a dividend. All the money that they earn every single year is put back into the business or put into their checking account to use for investments at a later date. Their market cap, so the price on the open market alone, has been increasing by 19.2% annually for the past 1, 2, 3, 4, 5, 6 years. This is an amazing return, definitely a market-beating return by any means. Of course, like I mentioned, they don't pay a dividend, so 19.2% is the number that you would have expected to have your capital appreciated by. The enterprise value is the entire value of the business. So we take the market cap, to which we then add the debt and we subtract the cash. And because their debt numbers are not growing, but their cash definitely is, we see a enterprise value growing less fast than their market cap has. EV/EBITDA. Now this is, I think, why this company becomes very interesting, because as you can see here, the multiple has been all over the place. They have all been positive, meaning that Adyen, since their inception, since their IPO in 2018, they have continuously made a profit. But their profit relative to their enterprise value is absolutely a massive gap. 2024 times earnings in 2017, and it came down to 47 times in 2022. Definitely reaching a more stable number here for 2022, but still a multiple of around 50 times is something that we only see for a small cap company with a massive growth trajectory, as is expected of Adyen. And exactly this is the reason why they saw such a massive drop off lately, because Adyen is priced to perfection. It's priced at 47 times earnings in 2022 because they have seen a massive growth in revenue and in earnings. Investors are speculating that Adyen will keep on increasing their revenue and earnings as they have been doing historically, and the moment that this doesn't actually come true, their value will come down a lot, because why would you pay a premium price for a company that does not nearly grow as fast as you want it to? The net debt to EBITDA is negative because they have more cash than they have debt on their balance sheet. No risk of bankruptcy here whatsoever. A relatively safe stock considering that. So let's have a look over at their cash flow. So something to keep in mind when looking at these numbers is that I took the stock price, their IPO stock price of 468 euros. Now this is the stock price as seen on July 2018, not January 2018, because they were not yet listed in January, they IPO'd in July. Therefore, take this number with a little grain of salt because it's not entirely accurate compared to the rest of the spreadsheet. Nevertheless, they saw a cash flow from operations starting with around 200 million in 2017, risen all the way to about 1 billion in 2022. Now, I do have a little side note here which says 1 billion in payables, and it goes for 2022 as well as 2021. What you have to realize is that Adyen, just like Visa or MasterCard or even American Express, which is a bit more of a premium card in the United States, is a payment processor, and with that also comes the responsibility of handing out chargebacks if it's required. Imagine that you buy a very expensive car or a very expensive sweater or jacket, and turns out the quality that was promised to you does not match the actual item itself. Therefore, you want to return back to the store and you want your money back, because all the transactions go via Adyen, via their payment processing system. Adyen has to pay you that money first, and then later on, hopefully, right, the car dealership or the boutique will then pay back Adyen the missed sum. So Adyen always needs money available for potential chargebacks in case that happens. They have 1 billion in payables therefore in their income statement, because this money is expected for them to be coming in, but they need to keep it on the side because they might have to use that money to refund the customer. The moment that we assume no chargebacks whatsoever in 2022, you can expect the additional 1 billion in payables to be added to their cash flow from operation. Additionally, we see a capital expenditure, so the cost basically of doing business and future-proofing their business, which is very, very low compared to their cash flow. 11 million in 2017, 95 million in 2022, which compared to their CFO is quite negligible. The moment that we take that cash flow from operation and we subtract the capital expenditure, we get the free cash flow. And the free cash flow is everything that's available for distribution at the end of the fiscal year. And they can do this either by paying a dividend, buying back stock, doing mergers or acquisitions, or simply buying back debt. They don't really have any debt to speak of. They don't really pay a dividend, so most of the money that they do make every single year is put into their checkings account. Additionally, even though it doesn't show in this column directly because of the decimal point, they do dilute their shares a little bit, which is also added to their war chest of available cash. The free cash flow per share is what you get when you take the free cash flow and you divide it by the amount of shares outstanding. Then you get the free cash flow on a per share basis, which is also increased by about 30% in line with their CFO. Price as seen on the open market started at the IPO date of July 2018 for 468 euros. A few years later, 2021, they appreciated all the way up to about 2,300 euros, after which they came down in 2022 to 1,300, and now they've recently come down to around 600. A massive, massive drop. Basically a quarter of the price, a quarter of the market cap that they had in 2021 is what they have right now in 2023. Now, a big reason for that is because they recently published their semi-annual results, which actually showed a 10% decrease in their earnings. They showed an EBITDA of around 330 million euros for the first half, and if you then extrapolate that to the full year, you get around 660 million, which is a drop of about 10% compared to the previous year. So like I mentioned, Adyen is very much priced in for success, priced in for perfection, with continuous double-digit growth. And the moment that Adyen not only sees reduced growth, but in fact a negative growth, this will heavily impact the valuation of the stock price, because it is priced for perfection. The moment that it doesn't reach that, the price will drop very, very quickly. The moment that a growth company stops growing is where you see a massive drop in market cap usually. But the question, of course, on everyone's mind, on every investor's mind should be, is this a one-time thing, or does Adyen continue to drop in their earnings numbers? This is a very, very tricky question to ask, and I really can't answer it. I do think 2023 was a bit of a down year for every single business in the world, basically. So I don't think it's that surprising to see with an economic downturn that a payment processor like Adyen might also see a downturn in their revenue and earnings numbers. But if you are a bit more optimistic, then you can possibly believe that they will actually bounce back the year after. Historically, they've grown their revenue and earnings by 50%. For their forecast, I'm going to drop that down in 2024 to an increase of 30%, which I will then gradually reduce all the way down to 15%, where I expect them to be a more mature company. Now, are these numbers accurate? I'm not entirely sure. The moment that Adyen actually has an additional off year where they see a negative growth anywhere in these 10 10-year time span that we look at, it has a massive effect on their enterprise value, as you can see. With one additional more down year, we get an enterprise value of 65 billion, without it 91. It makes a world of difference if a growth stock like Adyen suddenly stops growing for a year. Also, I'm going to attach a market multiple of 22 times. Now, historically, they have on average been at 118.5 times earnings. But this is because Adyen has a relatively small market cap and very variable growth rates. This is very much a growth stock, and growth stocks are always priced with very high multiples. But the moment that we look 10 years down the line, which we do in our projections, I expect them to become more mature. I expect them to then see growth in line with other payment processes like Visa, like MasterCard. Visa and MasterCard have a multiple of around 22 times, so I'm going to give Adyen the same multiple here 10 years down the line. This gives me an enterprise value with my relatively optimistic growth forecast of 91 billion, from which we then subtract the debt, we add the cash, giving us a market cap of 97 billion. Divide this by the amount of shares outstanding, and I get a share price 10 years from now of 3,148 euros. For that free cash flow model, I'm going to do a very similar thing and attach a free cash flow yield of 6%, which is also the number that companies like Visa and MasterCard are trading at. This gives me a stock price for the free cash flow model of 2,749 euros. Right now on the open market itself, I can buy as many shares of Adyen as I want for 640 euros. Taking both my projections, so the enterprise value as well as the free cash flow model, I expect a share price 10 years from now of around 3,000 euros. This gives me a compounding annual growth rate of 16.5% and an IRR, so an internal rate of return, of 25.6%. And I do have to say, this is once again assuming a relatively rose-colored forecast here with continuous double-digit growth. If you do not expect this to happen, these numbers will be a lot lower. To give you an indication of this, let's give them minus 10% for 1 year. Suddenly the IRR already drops to 21% instead of 25.5%. It makes a world of difference. So let's see what happens if the price goes up or comes down a little bit. So the moment the price actually moves back up to around 830 euros, I still expect an IRR of 21.1%. If the price drops even more to, let's say, their IPO price, I expect an IRR of 32%, which is insane. That number is so high I can't even fathom it. On average, the market returns about a 10% IRR and about a 7% CAGR. And I think Adyen definitely outperforms the market consensus here. But this is also because they have very much fallen from grace, fallen from the 2,300 euro share price. Let's see actually what our IRR looks like the moment that we put in that number. I expect an IRR of 6.3 and a CAGR of 2.5 with still a relatively rose-colored projection. So obviously 2,300 2 years ago, but not even right now when the earnings are higher than they were before, but 2 years ago, this company was truly priced for perfection, and it doesn't surprise me at all that the price has come down a little bit. I do think it's come down possibly a little bit too much. I think around the 1,300 is maybe a more fair price for it right now, but that's once again considering a relatively rose-colored projection. Nevertheless, I do think there is a lot of potential cushion being built into this IRR of 25.6%, that even one additional off year will still give you market-beating returns. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!